cities and regions, tier 2 and tier 3 cities, at like Portland at the time. And if I put a small fund or a sub $50 million fund, be a big fish in a small pond. And that thesis has proven to be successful, and we're now investing out of our fourth fund. 2-3 years ago, I was at an event like this for women founders and CEOs. There's probably 100 people there, and I was the only male that showed up. And
Lucky
if
guy.
anybody, if you guys know about what it's like for a women CEO or founder, like for every $100 invested in venture, I think less than $1 or $2 goes to a female founder. And so Rogue's been lucky enough to be successful. So I said, I want to be part of the solution instead of part of the problem, and started the Rogue Women's Fund. I hired a woman at a Nike who was managing digital there to run it. And so we have a fund that invests only in women CEOs and founders. And we're going to go out and raise our second fund there. Outside of that, I now live here in Rhode Island, and I see a lot of similarities to where Rhode Island is to where Portland was, say, almost 10 years ago. So I'm excited to be here and part of the panel and start investing in great startups here.
Hello, I'm Thorne Sparkman from the Slater Technology Fund. We're a pre-seed and seed through Series A and B investor. We invest in software, life sciences, and energy technologies, all in companies doing stuff here in Rhode Island. We just launched something called Right Hill Ventures, which is a practice within the firm to invest in deals coming out of university networks. So if you're a researcher at Brown or URI or the Naval Undersea Warfare Center, then we're looking to invest in that kind of stuff. Thanks.
Let's see if this works. Check, check. All right. My name is Aaron Samuels. I grew up here. How many people here grew up in Rhode Island? Okay, cool. That's what I like to hear. So I grew up, I was pretty involved in the poetry scene here. I grew up, I repped Providence a few years on the Providence Poetry Slam, spent a lot of time at AS220, and then fell in love with storytelling. We wanted to find a way to scale storytelling on a larger level. So I founded a media company. The media company called Blavity. The goal was simple, so simple we wrote it on the wall. We said we wanted to create a world in which all Black people are happy. We think that makes a better world for everybody. 8 years later, we are now the largest Black media company in the world for millennials and Gen Z. We reach a little over 100 million people a month across 5 different platforms. 3 of those we built in-house, 2 of them I acquired. And one of those platforms is a platform called Afrotech, which grew to become the largest Black tech conference in the world. So at Afrotech, I started meeting amazing entrepreneurs, realized I had a passion not just for building Blavity, but wanting to create 100 Blavities. So 2 years ago, I launched a venture capital fund to invest not just in Black founders, but diverse founders across the board. 2 years later, we're still newer than these guys, but we've done 34 deals. 87% of the deal flow goes to Black, brown, or female founders. And looking specifically at APIs, supply chains, and Gen Z focused brands. That includes a little bit of crypto and Web3. But personally passionate about the Rhode Island startup ecosystem and wanting to find ways to share the knowledge, share what I've learned, and ultimately find a way to work with great Rhode Island entrepreneurs.
Great, thank you all. I mean, I think entrepreneurship is alive and well in Rhode Island, and we're glad to have our panelists this evening. We haven't even started the discussion yet. So let's kick it off with probably the easy question. There's a pandemic wrapping up, if you will, and what are you seeing out there or hearing out there as the state of what the investment and funding opportunities are going to look like in the next weeks to coming months? So let's kick that off with Tom.
Yeah, I mean, 2 years ago at this time, the world was shutting down, and I would say that the venture world was very worried. We were telling our companies to stash cash, become profitable, cut where you needed to cut, and we were worried that our companies were going to be in for a tough road. The reality for Rogue and our portfolio companies has been the exact opposite. Most of our companies have been wildly successful during the pandemic. the businesses that they were in, but I would really say at the end of the day, the entrepreneurs, having dug deep and gone through what we're all going through and been able to be successful, show up, be great leaders and stewards of capital, has been, the most impressive thing I could say that I've seen. The access to, look, the private finance space that we all play in, there's so much money out there right now for great founders and great companies. It's kind of stupid, to be honest with you. The valuations are insane. I don't see, I'm more worried, I'm less worried about people finding money. I'm more worried about how they're going to get to a liquidity event that makes rational sense with the valuations that are out there. So.
Me? Okay, good. So I echo a lot of things Tom's saying. Somebody said to me, a wise guy said to me when a wise person said to me when this all started, nobody will ever raise more than $100,000 without shaking hands. And that turned out to be wrong. So there's a lot of activity out in the world. And I thought we were going to kind of go to ground for a while, but it wasn't like that. Companies were acquired. The Slater Fund had 2 or 3 exits in pandemic year 1. And we've had more than that in year 2. And we're being as active as we possibly can. So I was really surprised by the exits, but thank you. And what I would say is harder is getting to know entrepreneurs. And the seed stage of investing is really about meeting the people, spending time with them, establishing trust, figuring out if there's someone that is going to be great to work with. And that is, I find that to be tough over Zoom, frankly, not impossible, but tough. So I would say that the activity is increased, not decreased, but that it's a little harder to be a seed stage and very hard to be a first-time entrepreneur, money raiser.
Yeah, I would agree. I think you have 2 simultaneous phenomenons happening, which kind of on one side, there's more capital than ever in human history that's being invested into the private markets and private equity venture capital. On the other side, still less than 2% of that goes to female founders, less than 1% goes to founders of color, less than 0.1 goes to women of color. And so while we have crazy proliferation of capital, we also have a big problem with democratization of access to that capital. And I think one of the things that happened during COVID is, I think it becomes a lot easier to then retreat to your networks. So while there's a lot of capital, if you can't get access to the networks of those capital, then you're at a disadvantage, right? So then we need to ask the question, both as VCs as well as startups, okay, how do we equalize that access? What does it look like to create robust digital communities as well as physical communities so that new founders, first-time founders, and founders from underrepresented ecosystems, whether that's demographic underrepresentation or geographic representation, like hotspots like Portland, like Rhode Island, how do we find ways of making sure that the connectivity to that capital is strengthened?
Yeah, I would just want to say one thing. Part of our, in theory, you raise capital from, your networks, right? So part of our thesis for the Women's Fund was to empower women to be financially independent. So we said we wanted 50% of our LPs to be women and to make the financial decisions whether or not they should invest into venture.
Everybody here know what an LP is?
So an LP is a limited partner with a person who invests in our funds, basically is an LP. Thank you for that. So going out and raising 50% of our fund just from women has been incredibly challenging. And it's just the same as going out as a founder, as a woman founder, trying to raise just from women who have A, the knowledge of the asset class, or B, have the opportunity just to make a decision on whether or not to put money into that sort of asset class has been an interesting challenge and learning experience.
Valuations. Valuations are crazy, ridiculous right now. And we see it, we work with a lot of private equity, and those multiples are even crazier. And Thorne, you are absolutely right. When the pandemic started, I didn't think you'd ever see a deal done without meeting in person. And we closed more deals on the due diligence side than ever in the last 2 years. So that's interesting that we've changed how we do things. But one thing hasn't changed. How should early stage entrepreneurs decide which type of funding to pursue? I mean, you're starting a company, you're basically sleeping on your parents' or a friend's couch, and you're eating ramen noodle. I mean, do you max out your credit cards? What do you do? How do you decide which way to go forward? And Thorne, I think it'd be great if you could kick that off. How do you decide which type of funding to pursue?
Okay, so the best money to get comes from customers. So if you can possibly get that, start there. That's by far the best. And after that, I'd say probably the second. So I guess we should acknowledge here that the shockingly high valuations is awesome for the entrepreneurs in the room who are raising money. So you guys shouldn't be, that's not a bad thing. I think if you can get money from non-dilutive sources, especially if it's so people who are not buying stock in your company, but some kind of a grant, I think that's a great source. Some grants can be a total pain, but you don't have to give away a lot of your company. So maybe that's a great source. And then after that, there are a whole bunch of criteria you have to think about. Some investors will only invest a certain amount. So if you're only trying to raise, so you have to think about how much you're going to raise, what kind of return you can possibly give back to those folks. And I think I'll let these guys kind of elucidate that.
Yeah, I can jump in as a founder. So I raised multiple rounds of capital over the course of my company. Pre-seed round, seed round. Our Series A was led by Google Ventures and Comcast. I learned a lot. It's wild. They say your first money, should comes from your friends and family round, right? So, I'm a founder of color. All four founders we're all founders of color. And so, we put our friends and family round together, and we raised about $30. And then said, okay, cool. We need to find a way to get a little bit more. And so for us, it really came, from asking for money from strangers, which is a different experience than folks have who come from communities that have access to a lot of capital. So if you're pitching yourself to a stranger to give you money, that's a very different type of conversation that you need to have. When you're setting the valuation, so real quick, just like who here has founded a company? Okay, cool. So we have some entrepreneurs in the room. So as you know, a valuation isn't anything other than just an agreement between you and your investors about how much of your company you are giving to them for the amount of money that they give you. We are years and years away of an exit or kind of a public IPO. So the valuation is quite literally just a negotiation. So oftentimes you need to think about that when you're meeting a stranger who wants to buy a piece of you. You are negotiating with them about how much of you they own based on how much money they're willing to give you. And that's a complicated, pseudo-friendly conversation that you're having based on the value that you are purporting to create for the world. And so oftentimes, I often encourage entrepreneurs to remember that mindset as you're going into the conversations. You are getting into bed with somebody, like if things go well, for 7 to 12 years. That's the average life cycle of a venture-backed startup. So you really want to think carefully about who you're taking money from, because these people will be able to call you. Their lawyers can call you. These are people that you are in a contractual financial relationship with for a long time. There can be negatives to that, but there can also be really strong positives to that. If you pick your investors well, these are folks that will go to bat for you, that will introduce you to other investors down the line, that will give you support, that will give you access to resources, et cetera. But oftentimes when we're first starting our companies, we're oftentimes asking the question, how do I raise 250,000, 500K, 750K now so that I can get my MVP out the door and start grinding? We're not always thinking about the question, who am I going to be in relationship with for the next 7 to 10 years? and how can that affect my life?
Yeah, I mean, to add to that, you might be creating a business that venture doesn't want to invest in. And so I think that's, or, so that should be thought of from the beginning. Then you don't want to waste your time talking to guys like myself. So that's one. Two, I would echo what everyone's saying. When we invest, we say, hey, we're about to get married, right? Not just get in bed, but get married, because there's going to be great times, but there's going to be really hard times, right? And so you need to really think about, are we the right people? And do your due diligence on us. Talk to other people we've invested in, who we've partnered with, who we've failed with, who we've had success with, and understand who we are as we're doing with you. And I think that's super important. But I think at the end of the day, I'm like, don't take my money. If you don't need my money, you shouldn't take it, because you're going to be much better off if you can be successful without taking venture and raise it and be, huge financially successful without it. But if you do, and we're in it together, we're going to help each other through thick and thin. I have been a CEO and a founder and taken bad money, and that is not a fun place to be. So I highly recommend doing really tough due diligence on the people you're going to take money from, because it can be tough. Even if it's from friends and family, it can ruin relationships, and that's not fun.
Holidays being weird.
Look, I mean, I would say from my experience, bad money is an investor that's not aligned with who you are as a person, what you're building, and where you want to go. And I think that's super important. I think an investor who doesn't help you and doesn't help you grow, shows up for quarterly board meetings, but doesn't do the work in between the board meetings. There are investors out there. There's so much money out there. I was just on a deal where an investor wrote a $20 million check and said, don't call me until you hit these metrics. That's not good money to me, because you're not helping that company hit those metrics. And they're their largest investor, and they basically controlled the cap table. And they wrote a check for $20 million. They're a $1 billion fund. 20 million doesn't mean anything to them. You hit those metrics, then they're going to be interested in you, because then they're going to see the return that they need. So that's really how I would frame it. It's about someone who you want to sit across the table with and dig deep, and then are going to be there in good times and bad. And there's a lot of folks out there who aren't. VCs, venture is a tough business, right? My mentor, who I respect a lot, told me, if that dog doesn't hunt, you shoot it and don't pay any attention to it, because you're not doing any good to your other LPs, because you should be focused on only the winners. So that means if your company isn't succeeding and hitting those metrics, I shouldn't care about you at all, because I should only pay attention to the ones that are, because they're the ones that are going to return my fund. And that's a very, very tough thing to do.
Yeah, I mean, it also depends on the level of institutionalization that your investor has. Taking money from angels is oftentimes a very different experience than taking money from VC firms. Per the point earlier, right? VC funds, most of them operate on, what's called a portfolio model, which basically means they do 40 deals over the course of 4 years, and they expect 2 or 3 of them to be remotely successful and one of them to be a unicorn. So ultimately, they're paying attention to all 40 of those deals until they start figuring out which ones are the most likely to become unicorns. And then they only focus on those deals. That's the way that most VC firms work, because that is how they have to work, because of who invests in VC funds. It's not even necessarily the choice of venture capitalists. If you take money from an angel investor, oftentimes angel investors, they're only doing a couple deals a year. Oftentimes it's personal capital. They're not investing on behalf of other people. So they're going to have a very different type of incentive model. And oftentimes they're going to be much, much more engaged and focused on your success. Now, the flip side is oftentimes angel investors are other entrepreneurs. They're super busy. They don't have large teams to give you resources. And so, there's cons to that as well. And sometimes they have idiosyncratic expectations. Like, they want their money back sooner. They don't really understand that they might be throwing away their 25K investment forever. And they might get mad at you, right? So versus, VC firms, they properly do this. So the expectations are aligned. I oftentimes recommend that founders have a combination of both. And when you are structuring your cap table, which is effectively the document of all the people that have invested in you, oftentimes you want to find a way to kind of hedge your bets. So you want to have some institutional folks who can connect you with resources, ultimately downstream capital for later funding rounds. But also you want some angels in the portfolio there who are going to go really hard for you. And who aren't locked into a portfolio strategy where they can only focus on their winners.
Sure. The venture capital, things that are right for venture capital are rare. They're rare. The venture capitalist wants to find something that is going to give him back 10 times his money or more. It's just rare. You almost have to be lucky and good, and all kinds of things happen. So there's a pretty good chance that a lot of people here that doesn't fit. Like even a lot of the things that I invest in, that the Slater Fund invests in, don't end up being that kind of thing. So while there's a lot of money out there in venture capital, that's great. And you can find them on the web by just Googling and see what they invest in. That's great. It may not be the right thing. So I think a lot of the time the question is, all right, if it's not that, what is it? Like if I'm not going to take $5 million from somebody and give them back 100, who is it? So 20 years ago, when I was raising money, you couldn't look up so-and-so angel group. Now you can. You can actually look up the angel groups. But angel groups really just like to invest in the same stuff venture guys do usually. So it gets harder and harder. The smaller the amount and the more esoteric the amount is. That's what I think. Harder and harder. So is anyone thinking that way? Like, I'm sensing venture capital may not be for me. Is there anyone thinking that way? Yeah. Okay. Well, yeah. You and I talked a long time. Yeah. Right. It gets harder then.
I mean, look, we keep our funds less than 50 million. Most M&A deals, the greatest percentage of M&A deals are sub 100 million. Okay. So if you're $1 billion fund, you need to be in a unicorn to be successful. For us, look, we're happy with selling a company for 50, 75 million and having a decent percentage of it because we're going to be able to return our fund easier and quicker. We only want to invest in companies where we can add value outside of money. So if you come to me and say, hey, write me a check for $1 million and it's in the life sciences space, I know nothing about life sciences. Even if I could make a ton of money, we'd say no, because we can't move the needle, and I would introduce them to Thorne. So for us, it's like, where are our LPs or our expertise that are able to help you, the entrepreneur, outside of the check we write, because that's where the real hard work goes.
Can I add something else? Okay. So here's two key things about the investor that's right for you, whether or not they're venture capital, angel, or other, which is you want them to have a bunch of money that they're going to invest. Seems obvious, but worth thinking about. And two, you really want them to understand a little bit about something that you're doing. So if someone comes to me and they have to explain it to me already, I'm like, oh, I don't really understand that. Sometimes they're really good explainers. Sometimes they're really not that good explainers, but I'm already uncomfortable because I'm not sure I'm going to get it. So I would think that, so who knows a lot about what you're doing, whether it's running a gym or putting stores into real estate. Someone else who's been really successful at that. Someone else who, and hopefully freshly successful. They just did what you were doing and they were successful and made a lot of money at it. When you meet them, they'll be like, I know what you're doing. Trust me, I get it. And they're gonna kind of want to hang out with you because you're interested in the same stuff. So I think that applies to venture capital as and angel investments and any of that other stuff. So when companies that work with Slater go to angel investors, we always look through who are the angels that are in that group. Some places they list each one, other places they don't. So if you go to Boston Harbor Angels, the old website anyway, used to say what each one did. And you don't really want to go through the pain in the ass. I guess I shouldn't be mentioning pain in the ass portals from angel investors, but you may not want to go through the whole process unless they're right for you. What you really want to do is find a kindred spirit in that group and call the kindred spirit. So I think the kindred spirit, the person who's done really well doing what you're going to do, even A, they're going to want to talk to you, and B, they're going to know about what you're doing. And I think that's maybe a good way to get started, no matter whether it's your friend and family, your angel investor, or your venture capitalist.
They will know people as well with money as well that are interested in that arena. So we've talked. Yeah. Oh, don't go ahead.
I got to say one more thing.
Okay.
If you go to that group or get that meeting or talk to that person, and the first thing you say to them is, so what do you guys like to invest in? Shame on you. Shame on you. It's your job to know everything that they've invested in and casually say, hey, you know what? Congratulations on points or something like that, because you know that they invested in that. Shame on you for going in and wasting their time. You would never do that, right? So know who these people are before you sit down with them. And we remember every single person that hasn't bothered to look at the website before they get there. That's terrible.
You know, you're segueing into the next section, but before we get there, we focused a lot on venture, on angels. Let's wrap up the actual cash as to what other sources are out there. I mean, is crowdsourcing even a thing? Is government grants? Thorne, you quickly hit on, I think, SBIR earlier, and I know a lot of the companies in your space probably get some of that funding. Can you talk about some of those opportunities that are out there and how sometimes they're non-dilutive again versus dilutive, and why there's a benefit to that? And I don't know, Aaron, can you kick off with that, you think?
I can kick off, although I will say most of our funding that we raised is venture. And now I run a $40 million venture fund, so I'm definitely biased. But I have a lot of friends who've done the crowdfunding thing. There's some great platforms. Republic is probably the lead kind of crowdfunding platform for startups. Familiar with Republic? Have folks heard of it? Okay, check it out if you're interested in crowdfunding. It's really interesting. It effectively it operates like a VC, investment in terms of it's still, exchanging equity for cash, but instead of taking the money from, one or two funds, it's taking it from hundreds and hundreds of people that can write checks as small as $50. The reason that it was created, and not to go like super deep on policy, but there's kind of regulations around accredited investors and what and non-accredited investors, and effectively what the kind of average working person is allowed to invest in. Previously they were pretty limited. You could only invest, depending on kind of where you are, somewhere between kind of $1,000 and $2,000 if you were not an accredited investor. They recently kind of changed some of those regulations. Republic was leading the charge to do some of that. I'm not exactly sure what the numbers are, but I think it's not that much, but it's up to $5,000 now that a non-accredited investor can invest. So basically, to be an accredited investor, you have to either kind of own $1 million in assets that's not your house, or make a certain amount of kind of combined household income a year. It's like somewhere between $200,000 and $3,000, depending if you're married or not. Which basically most of America is not an accredited investor. So what it said is, if you're not an accredited investor, you are very, very limited in the amount of money that you can invest in startups. So platforms like Republic did is they said, now you can get 100 people or 1,000 people to each write you a $5,000 check or a $1,000 check, and that can function as the VC investment. And so it's platforms like Republic, WeFunder is another one that kind of really have opened the doors, especially to folks that don't come from communities where they can, ask a friend or family for, a $500,000 check or $1 million check. If you can create a really great campaign on Republic, then you can share it with the thousands of people in your network. You can maybe cobble together a pre-seed or a seed round. It's substantial. I've seen people raise, $3 million, $4 million off of Republic, and that has kicked off their company. So it's definitely something worth considering.
There are downsides to that though. We just invested in a company that raised a bunch of money on WeFunder first. And because the regulatory issues are still not hammered out yet, suddenly they didn't just have WeFunder on the cap table, right? One investor, they had I think 700 people on their cap table. So suddenly you think you have one investor and then suddenly you have 700 investors, all who have written $50 checks, which means your cap table is a total pain in the ass, and those investors are a total pain in the ass. And as a fund, we now have to deal with people who are unaccredited, and that is a major regulatory issue for us. So again, go investigate. I think one of the key things we're trying to say is go investigate, find what's best for you. There are pros and cons with everything, and crowdfunding, there are pros and cons with, especially if you're looking at taking bigger checks from VCs later on.
Totally agree. Also, a lot of folks that crowdfund never go on and raise money from, other VC funds too. And so, this issue is a huge issue. I mean, I honestly think it's more of a regulatory issue. I think we can fix this with better government policy. But for now, that'll create, problems for downstream capital. But if you ask yourself and you say, actually, I don't want to raise 4 or 5 rounds of funding, but I think that this round will put me in business, and then I'll become a revenue generating operation that then can kind of self-fund. That would be the counterbalance. So absolutely depends on the business.
Well, so that stuff is awesome. So by far the largest investor in Rhode Island is NIH and NSF. We're talking billions of dollars. So the National Institute of Health. So there are agencies in the federal government that that put money out there that is free money, but there you have to do certain things with it. And to get it, you're generally advancing some science, and it has to be, you'll end up, the quality of the science will be reviewed by other scientists. So it's not easy to get. It's more like something that a researcher in a university would get. But it confers quality because it is peer reviewed. Other scientists have looked at it. The SBIR is the Small Business Innovation Research. That doesn't make sense, but anyway, SBIR. And you can go onto SBIR World and look for all of the different grants that you could get. And there are thousands of them. So difficult to get. But that's, it might start at $250,000 and end up at $750,000. And you have to get it and do what you said you would do. And they're incredibly painful forms to fill out. But the point is, it's a lot of money and you don't have to sell part of your company for it. So being good at that is a serious art to starting a company, but it's a great way to do it.
Non-dilutive funding is phenomenal. And I would remind everybody that the cash affiliated with winning the Rhode Island business competition is non-dilutive. So, I'll just highlight a couple other areas in Rhode Island. Rhode Island Commerce Co-op, if you go to their website, they always have some type of grant funding or some programs available to entrepreneurs. So take a look, because from time to time those change.
Commerce Rhode Island here tonight.
I saw her earlier. Oh. You're on the spot. Commerce Rhode Island, grants for entrepreneurs.
Mr. Kerry Bond, did you check the chat? Sent a message to you.
No, that's great. You know, I will highlight that only in Rhode Island could you just mention this and somebody pops up, because that's what they do. You go to other states, that doesn't happen. So thank you. So just to follow up for those online, Rhode Island Commerce Co-op Innovation Vouchers, as well as the Wavemaker Fellowship, are two programs you can check out. And I assume at the website, Rhode Island Commerce Corp website.
And match the award and augment the award. So they can tell your quality if you win one of those things. So the state will just say, oh, here's another automatic 50, is it 50K? Something like that. It's on the website. Dr. Sully.
So small business innovation research grants are from the federal government, but if you get one in Rhode Island, you might get more money because you've already been vetted, is the takeaway, and it's non-dilutive. So, you know, the other thing I'll mention is the SBA. For years, the SBA was a mature organization, wasn't necessarily great, I would say, for entrepreneurs, but they were the ones that kind of were the gatekeepers for a lot of the pandemic money. And so there are some programs out there now for entrepreneurs, just know through the SBA. So let's switch gears. We've talked a lot about the type of funds that are out there. We've talked a lot about money. What we haven't talked about is, what should an entrepreneur do? How should they approach? What should their overarching goal be the first time they walk into your office? You know, Thorne mentioned already research the person, but can you talk about, you've clearly seen a bunch of entrepreneurs. Can you talk about what it is that they should be prepared for, what you're looking for from them in that initial meeting, and how somebody should properly prepare or present? And I don't know, Aaron, you want to kick that off, or?
Yeah, I'll kick it off. So I'll try to frame the conversation. So I think there's really three types of investors out here, and no investor is gonna admit to this. Every investor will say they do all three of these things. But if you look at, you know, do your homework and kind of look at investors' track record, you can see where they fall. So I think, you know, investor bucket number one, they really like to invest based on your story, right? They want to know what your vision is for the world, your assessment of the problem in the market, and how you're going to solve it, right? Oftentimes we say these are people that care about story, they care about founder market fit, they care about big problems, and they get excited that you're going to solve those problems, right? There's a second category of investors that care a lot about early stage traction. So effectively, this means traction that is not associated with revenue. So this can be a lot depending on your various industries. For media, this meant users. It meant, you know, how many people were kind of monthly active, you know, uniques coming to the site. It can also be downloads for an app. It can mean engagement. It kind of depends on what your industry, but they're saying, what are those early signals that you have some fire to what you're building? And they care a lot about early stage traction. And then the third category of investor cares about early stage revenue. There's a fourth category that cares about profit, but that's really more when we're getting up the stack with kind of private equity stuff. So in the venture world, I think it's mostly these three, right? There's story, there's early traction, and then there's revenue. And oftentimes, if you can't tell based on the companies and the stages that the VC funds have already invested in, you can often tell based on the questions that they ask you when you're meeting them. And you can very quickly kind of assess, oh, these are people that really care about the fact that I don't have any money yet, or they want to know how I'm going to monetize. They want to know my path to revenue, versus if they're spending a lot of time asking me about the market, asking me about the demographics that I'm trying to solve for, asking me about the problems. It is my recommendation that you try to match what you're already good at pitching to the types of investors that are interested in the story that you're trying to tell. Right. So oftentimes, and this again, it's not a direct correlation, but oftentimes those things match funding rounds. So the pre-seed, oftentimes you're going to see the biggest clusters of investor that really care about story. At the seed stage, you're going to find the biggest clusters of investor that care about those early traction. And at the Series A, you're going to find, the largest clusters of investors that focus on revenue. But it's not a perfect match. And you'll find all three of those types that kind of scatter across all three rounds. So oftentimes you want to be honest with yourself about your own company, where it's at, what you think the strongest value is, and then say, what is the version of the pitch that I'm going to give today? And who are the types of investors that are going to be most receptive to that pitch? And if you can line that up early, you're going to increase your success rate when you're pitching for investors.
Yeah, I think that sounds right about myself, I guess. I don't know. I would say we're early stage. We say, and really, I believe this, want to invest in great people first and foremost. Probably how they tell us their story is critical. Some traction, revenue. We like to say we like to see some revenue, but we're willing to kill that. I just invested in 2 female founders who are seniors in college. That is very rare for a VC to do. So we've kind of break all our rules, but our rule is that they're 2 great human beings solving a huge problem, and they're the type of people you would want to bet on every day. So for us, they didn't have any revenue. In fact, they're still trying to figure out the revenue model. They didn't have an app launched yet, or they're about to have it launched. I don't think they had it launched before we gave them money. And so at the end of the day, it was their story and who they were as people. And, for us, it's those three things are critical. And then take our experience over the last 10 years, where we can add value, right? Where have we been successful in the past that we think we can then move the needle for them? That's super critical. If we can't move the needle, none of those other 3 things really matter.
Those are some great points. The Slater and Right Hill Ventures end up investing in a lot of early stage things, a lot of things that are not coming from entrepreneurs. They might come from technologists. They might come from researchers. So I look for depth in the area that they're talking about. A lot of experiences, a lot of knowledge, and I hope they have a ton more of depth and experience and knowledge in the area than I do. And therefore, I hope that they're good explainers. People who are good explainers and persuasive are going to be good at a lot of different things. So that's what I look for. There are definitely going to be gaps if there are small numbers of founders, and I wouldn't try to hide that. Actually, the opposite. I look for self-awareness. Do they know what they don't know, and are they able to augment that? Are they willing to augment that? So those are just a few things.
I will tell you this. Here's where I failed in investing in great things. I failed when I get caught up in FOMO, right? When I see a deal that all these other quote unquote great investors are in, or there's great people, quote unquote great people on the board, and therefore, why am I not putting money into this deal? When I move away from my thesis of who I invest in and why, and go because I think I need to invest in this great crypto thing or whatever the hot thing of the moment is, I've always failed, and it's a key learning for me never to do that. I'm super hardcore about it.
That's not true for most investors, though. I would say as a founder, try to create as much FOMO as you can.
So I've talked a lot tonight and asked a lot of questions, and our panelists are talking a lot, but our audience hasn't. So at this time, I'd like to open up the discussion to questions from the audience. And I will caution you, though, that I may have to cut you off if your question is long-winded. So if you have a question, now's the time. Please raise your hand. Let us know. You, sir. So I'll just repeat the question for those online. So the question is to Aaron and Tom, what type of entrepreneurs are you looking for? What type of investments are you looking at? I believe is the general question.
Sure. So a couple different ways to answer that question. So first is kind of the three thesis buckets that I look at. So the first thesis bucket is called API proliferation, basically saying that the world is becoming increasingly decentralized in the way that the technology stack works, but end users want streamlined solutions. So there's this whole thing happening in the mid layer to rectify that. You see a lot of that work happening in future of work, in health tech and in kind of fintech infrastructure. So we look at kind of companies that help kind of draw those connectivity points. The second area is supply chain redesign. We look at like the circular economy, regenerative economy, effectively saying large corporations want to be less wasteful, want to have better supply chains, but don't have technology solutions to be able to do that work. So there's a whole cast of folks that are building technology that enables businesses to be the good actors that they want to be. So there's some really interesting innovation happening there. And then the third category, I term it authentically imperfect, but basically it's my take on Gen Z. So both my parents are clinical psychologists. And so when I grew up, like you didn't talk about therapy. You got made fun of it or you kind of hit it. You go on TikTok today and these kids are bragging about how much therapy they go to. My therapist is better than your therapist. I'm doing the work. I'm building in public. I'm celebrating my imperfections. And I believe that mindset shift is actually indicative of a broader consumer trend in the way that we're thinking about buying behavior and ultimately corporate leadership. So we look at companies that kind of are riding that wave. Crypto is a part of that, and what's happening in Web3 is a part of that. But I actually think it's a larger mindset shift that's happening generationally. So in theory, I look at founders that kind of come from one of those three archetype kind of areas.
Yeah. So let me say this. So I founded the fund in Portland, Oregon, because there was no local capital. So we look at undercapitalized cities. So we won't do a deal in San Francisco, New York, Boston. In fact, when my buddies, unless it's a close buddy of mine and they're at another big fund and they're like giving us a tiny piece because they feel sorry for us, that's interesting. But when somebody starts sharing deals with me from those cities, I know they're terrible deals because there's no reason I would be getting a great deal from those cities. So that's number one. Number two, we are capital efficient. So we don't look at like hardware or, consumer goods or life sciences or anything. That's not our expertise, and B, that's very expensive, and our fund model doesn't work for that. I would say this though, like I think it's super critical at in a place like Rhode Island that we all work together. We shouldn't compete on deals. We should work together. We all need to make this a great state and a great city, and build that next generation of wealth and build those next generation of great companies. And the only way to do that is if we all help each other. And it's not just on the funding side. We shouldn't be competing on term sheets, right? We should be working together with all you great entrepreneurs to give you the capital that you need to be successful, because there is a lack of early stage capital in these tier 2 and tier 3 cities. Capital is just one of those pillars that's needed. And so from my perspective, we love the Rhode Islands of the world because we can be a big fish in a small pond, and we want to work together. We don't want to compete with big funds. We want to work with our partners here and then take you to the big funds to, get that those next rounds. Because at the end of the day, without us doing that, these cities and towns and rural areas are going to still suffer.
Thank you. That's so refreshing to hear you say that, Tom. I mean, as Thorne knows, I've been kicking around in this scene for 20 plus years. And I think the thing I've seen is we've had some great entrepreneurs. We've got some great higher ed institutions locally. And the thing that's always chased the entrepreneurs away has been the lack of capital here. And so that is amazing to hear that you and Aaron and Thorne are here and alive and well and willing to do deals. Any other questions?
So you were just talking about how you love the Rhode Islands of the world and you don't want to be competing, which is great. My question is, what can be done or what is being done about just letting the general public know, or the next person who has that next great idea know the funding options that they have? Because sometimes it's not an information issue or a funding issue. It's like a marketing and promotion issue. I have friends who are trying to start companies and they don't even know about this building, let alone this event, because they don't hear about it, or they go and try and start something and then all of a sudden, oh, I didn't know Rhode Island had these grants and these programs and this. They find out after the fact because they have to go through like 8 to 10 steps just to get access to the information, let alone go through the application process. So my question is, what can be done or what is being done just to promote the fact of like, hey, you have these options and this is how step one occurs, rather than, oh, you need to do your research. Not everybody knows even how to speak the vocabulary and how to walk into that room, let alone do the research. So what is being done on that end, or what can be done on that end?
Have them come by. Have them come. There's free beer. We're on, Twitter and LinkedIn and Google, and let's talk about it afterwards.
Yeah, I would say, look, I agree with you. And I think probably most of the people in this room, agrees with, right. We're here because we're trying to build out an ecosystem. I moved to LA in 2014. And at the time, the venture ecosystem there, really didn't exist. And I watched the entire ecosystem grow. I think, oftentimes a few things happen that really spark a great ecosystem. I think first and foremost, it's a couple really great startups that decide, to set down roots here, right? And then they hire, they create events, and startups are way cooler than VC funds, right? So like that's where the energy lives. And oftentimes, great startups yield great VC funds, either set up locally or attract kind of out of state talent to want to set up shop here. And then I think the third component, when it works, is in really great public-private partnership. So then you get a combination of state level events, city level events, and potentially federal level programming in concert with these things. And I think all of these three things need to happen. I think the good thing when I look at a room like this is I think there's folks here that, I think everybody in this room is involved in at least kind of one of those three areas, whether it's kind of the startup ecosystem, potential funding ecosystem, or government ecosystem. And I think the way that the word gets spread is when all three of those ecosystems work in harmony with each other.
What we did in Portland, we got together all the time, right? So we obviously COVID sucks, but the ecosystem was very, very social. Lunches, dinners, beer pong, whatever it was. And that was driven by all of you guys. And that you guys, again, it worked together. You didn't compete for talent. You helped each other build great companies, and the best companies would rise. And then everyone would go work there and hopefully be successful and raise venture funding. And out of that, someone in the ecosystem created a blog and blogged every day about what was going on. And everyone started reading that blog. And then he started tweeting about what was going on through that blog as well. So suddenly the ecosystem drove everything that you were talking about, not us. It was the folks that were living and breathing, trying to create these great startups. And that, we do in Portland, we do a beer pitch event once a month. I smoke cigars. I don't drink beer, so I would smoke a cigar if you want to sit with me or not, whatever. But where people would come, we'd buy beers for everybody, and they would get 3 minutes to hang out and pitch to us and stuff like that. But suddenly the ecosystem grew out of that, right? We just have to start doing way more of that type of stuff.
We have a question online.
This question is from John Barlow, and he prefaces by saying it's kind of hard to get traction if one doesn't have the money to build / develop a good model to demo. So how is traction defined for life science companies that are forbidden to have any sales until they have spent years satisfying FDA requirements?
I'm the life sciences person, I guess. Yeah, so traction in life sciences is not approved products, but there are plenty of other things that you can do to show efficacy. And the farther up that tree of efficacy you get, the more proof you're showing. So there's, proof in animals, there's proof in petri dishes, there's proof by having won grants, there's all of the above. So that would be the answer for life sciences rather than sales.
Thank you. Hi, I'm Amber Jackson. I own the Black Leaf Tea and Culture Shop. So I had a quick question. I know you mentioned before that you just invested into college students that haven't really started yet. And so my question is, if you can share any of your recent investment partnerships that you have, what was it about them with that encounter that made you say, I want to invest in you? If you can share.
I can kick this off. So I spent some time working with a VC fund called Lightspeed Venture Partners. They're based in the Bay Area, and they have a cool concept that they call founder market fit. And so effectively, it says, does the person that I'm talking to have the skill set to solve the problem that they're trying to solve? And what is the evidence base that they can do this? So it doesn't mean that you've needed to solve that exact problem, but it's saying, okay, if you're building a music company, were you a musician? Did you work in the music space? If you're building a CPG company, did you work in CPG? So it's basically asking, what's your background, and it's finding a way to tell that story credibly, to say this problem is a big enough problem that it'll make a difference in the world, and then 2, there is a solution for it, and 3, I'm the person that can solve that problem. And I think oftentimes that's what gets that initial hook for investors, because if you can convince them in the first 3 to 5 minutes that you are uniquely capable of solving a huge problem that nobody else can solve, then they're going to want to know more, and then you got them, right, and then you reel them in.
Yeah, and again, all of that's true, and then it goes back to also, how can we help them solve that problem outside of the capital that we write? Okay. The 2 women are also sitting right behind you, so you can talk to them right after. But sorry, I'm totally embarrassing them. But so their company's called Points. It's, I'm going to simplify it. It's ways for micro mobility. Okay. Scooters, bikes, things like that. Micro mobility is the future. Cities are pushing it. Safety, things of that nature. Portland, huge in the space. We have relationships from the city side. We have relationships in the sports side. We have relationships in the founder side. The founder who created City Bike and e-bike is some of our LPs and friends. And so for me, it's, am I willing to take a bet in something? I don't ride bikes. I hate biking. I hate bikers. Okay. But they're awesome people who are going to solve this problem. And can we move the needle for them with our relationships? That really helped us make that decision.
Hi, everyone. My name is Taro Machala, and I'm the founder of GoTef, a superfood and wellness brand using the ancient grain teff. I have 3 questions, but you don't have to answer them all. I'll just shoot them out, and then you can answer which. But okay, so I'll start. The first question is in regards to bad money, right? It's hard to know if, I mean, of course, you can look online and study the portfolio of a VC or an angel group, but to understand if the company or the fund will be there for you through thick or thin, what is the best way to vet and understand that, especially when you're a founder doing a million other things as well, building the company, working on the product, marketing, sales, etc. Is it talking to the portfolio companies? Like, I'm really curious about like your thoughts. Is it more instinctive as you conversate with those people or pitch to them? Okay, that's one question. And then in terms of when you have a limited timeline and a need to fundraise, especially at an early stage when you're at a point where you realize, okay, I need to fundraise to scale this to the next stage. But you also have a certain timeline you have to achieve that in to get to your goals. What is your advice in terms of sometimes you can make bad decisions in desperate times? What is your thoughts on that as, speaking as a founder who has, again, you have many different jobs and fundraising can be a full-time job on its own. Okay, third question. When you get different advice on amount to raise, sometimes it's easier to raise a larger amount than less. But if you're particularly at fundraising at an early stage, it's your first fundraise, what would you advise in terms of, you can always raise more money and, use it. So your thoughts on that, if you're cautious as to how much of your company to give away at such an early stage?
The first question was, the VC should introduce you to their portfolio companies, so you should talk to them. You should ask the VCs who their investors are. So who invests in you, right? And you could figure out from there, can those investors help you and add value to you, and who can they bring to you the table of their network, right? Look at their deals, look at where they've been successful. And the other thing to ask is how much money they have to write a check to you, right? Because they might just be able to write a one-time check and not follow on and things like that. I think where they are in the life cycle of their fund. And I think that's important. Also find out what partner will be working with you, right? Are they going to be the person writing the check and then they're never going to talk to you again? I think all those types of things are super important. I don't remember the second question. The third question was, and you guys jump in, but how much to raise? I would say it's a tough question. I'm a big believer of, strengthening your balance sheet. I'm not sure you can always raise more money. It just depends on how successful you are, where the world is going. I'm not a big worrier on valuation because at the end of the day, you own 100% of zero today until you exit, right? So, and if you're a great entrepreneur and you've been diluted, good boards and good VCs will give you more options because they want I'm only successful if you're successful. I am highly motivated to make a shit ton of money, a lot of money, because that's the only way I'm going to make a lot of money. So I'm highly motivated to make sure that you're highly incentivized always. So my job is to take care of you and your team because you're going to be taking care of us.
Yeah, I can jump in on this. It's a slightly more, nuanced perspective. So this is the kind of second two questions. I think they go hand in hand, right? So your second question was basically like, look, if I'm running out of money, I can make a bad deal. Should I take the deal versus, have my company die? And, of course, the obvious answer there is don't run out of money, right? Find a way to not get in that position in the first place. So, and that comes to your third question, right? So how do you raise enough money to make sure that you're not in a situation where you might take a bad deal? We can talk about what we do, in bad deal scenarios, but first, let's try to avoid it. That's the best way to do it. I oftentimes recommend for founders, and again, this is just my experience as a founder. There's no hard and fast rule here, but my recommendation is ideally at the Series A, once you've completed your Series A, which in today's funding environment is oftentimes your third round of funding, you ideally want the founding team to still own a little over 50% of the company. Because then you still 5-0, because otherwise the board is going to then control your company, right? So you can mathematically backtrack that, and happy to talk to any founder here that wants to think about that. But effectively, if your Series A is going to be at a $30 million valuation, you're raising post money, you're raising $5 million on that. That's a $25 million pre-money valuation. And you can think about, okay, that 5 on 30, 5 on 25. That's going to give away a certain amount of the company. That'll give away 20% of the company, 20 to 25%. So that means you're already, you know that you're going to give away 20 to 25% of the company at the Series A. So then if you're raising a seed round, that means you only have, 25% to give out. So if I take 15% dilution at the seed round, then that means if I'm first starting out and I'm raising a pre-seed, then that means you should only want to take 10% dilution if you want to set yourself up to still be able to get there to the right stage. So then, okay, if you're raising a pre-seed round, oftentimes, those valuations will put your company at around $5 million. So then, what's 10% of $5 million? It's $500,000. And so oftentimes, I say to founders, maybe you ask yourself, can I get it done with 500,000? Now, none of this matters if you can't get it done, right? If you need more money to get to the next funding round, then that takes priority over what I'm saying. Because if you don't get to the next funding round, if your company dies, then the game's over. But if you think you can find a way to model it out so you can get to the next funding round and only take 10% dilution at the pre-seed, then you're setting yourself up to be able to take up to 15% at the seed, which is great. And then similarly, to be able to set yourself up to take up to 25% dilution at the A, but still feel comfortable that you and your founding team still has full ownership of the company. So oftentimes the game is, there are mathematical solutions to be able to backtrack this that you can model out. But it also is correlated to what you're going to be able to do with that money, and if that is going to be enough money to get you to the next stage, which ultimately is the more important thing.
Thorne, go ahead.
No, I can't. Okay, so I would say maybe tying a couple of my things together, that talking to some of the people, as you suggested, who have worked with that person before might be a good way. It might be hard to do, but you probably need to talk to those people just to meet that person, right? You may need to find those. And I would say it's probably easier to reach out to the entrepreneurs than to the investor who are busy and triaging and stuff. But it's a good idea to meet those people anyway. Those people will be advising you. And so being in that milieu. So if you're in the food, functional food or superfood space, there are not that many people that invest in that. So you should probably know who they are anyway. You should probably know who their portfolio companies. You should probably have an encyclopedic knowledge. You already do, but you should know who those people are and be talking to them. So understanding that space and those people and networking a lot is a good idea. Number 2 was about how much time you spend at it. Yeah, it's going to take a long time. Number 3 was, I would say, take it all. I would say take all the money the world will possibly offer you at any one time, because it's going to come in handy. And if they offer you so much, I heard a lot of numbers there, which, and I'm sure they were right. But if there were a lot of people throwing money at you, first of all, high class problems. Second of all, they probably will. Some of them probably will still throw the money if you say, but geez, can't we raise the valuation a little bit so I can get you guys all in the thing? So I would say take it all.
So we have another question online.
And this question is from Judy Isaacson. What do investors look for in a team, and what issues raise red flags? And just a quick note for Tom, there is a mic by your foot. Someone in the chat wanted to point it out.
Yeah. So look, I think great companies are built by great teams, not by great individuals. So oftentimes, first and foremost, I'm asking the question, is there a team? Many times, there's usually one person on, the founding team that does more of the pitching. So the question is, okay, how do you make sure that investors are meeting the other people on your team that are kind of building it? Second thing I ask is there a person on the team that has the technical expertise to be building what you're building? So sometimes that's the CEO, but oftentimes it's not. And in which case, if you're building a tech product, I want to know, okay, do you have a CTO, or do you have kind of a lead engineer that kind of is early stage on the team? If you're, et cetera. If you're building something in health tech, is there a doctor on the team, or is there somebody that has experience there? So oftentimes you're looking at kind of the capabilities across it. And then the third thing that I personally look for is, what is your ability to hire? If you're going to be a successful company, ultimately you need to be able to attract talent that is going to want to work for you. You're going to probably want somebody to quit their job and come join your company for less money that they're currently making. So when I'm talking to the team, I'm asking myself, are you the type of person who's somebody who quite possibly is going to be older than you and more experienced than you, is going to quit their job and risk their life and livelihood to go work for you for less money? And so I need to believe that you have the ability to grow a team underneath you, in addition to also work with the people that you founded the company with.
Yeah. Oh, me? I agree with all those points. And I think it, for me at the end of the day is to add on to that, is someone a subject matter expert that knows whatever they're selling me more than me or the people around me. I would say, do I feel that they're authentic and have super high integrity? And are they people I want to spend time with? And that I think can learn and listen and be good contributors to society at the end of the day. I've turned down deals where I've been able to make a lot of money because I can't stand being in the room with that person after 35 seconds. And so that's just, my LPs might not like to hear that, but at the end of the day, I want to work with good people who are doing good things and have super high integrity and are going to change the world and be good contributors to society and make me a better person. So
I agree with that one. What the Chip Hazard calls the Pied Piper. Definitely agree with that one. So I guess I'll say there are a lot of red flags, but I like people who see the entire range of competition and everything that is even slightly competitive. I don't, rather than the opposite of people say that there's nothing quite like what I got. I like the people who have a really broad view of competition and can explain it to me.
I can say who we stay away from. Would that be of help? Or we try to stay away from? We try to stay away from like husband and wives teams or brother and sister teams or brother and brother teams, unless there's clearly defined roles for who's going to be the boss when shit hits the fan, right? And we don't want to see families broken up because of that. And in the startup world, that is very, very common. So we're very strict about it. We've invested in one husband and wife team and they're doing super well. But when we don't see a path to solving those problems, we will not invest in those companies. And that's just been a red flag for us. The other thing that we've seen, that this is just random data for us, CEOs who've been great team sport players, we've had great success with that. CEOs who were very much individual sports people have actually been trouble for us because they've been more individual players rather than team players. Just some random data.
I was a track runner. But what I also say though is, I agree with pretty much what you just said though. So I think that there's a sweet spot of level of closeness of the founding team. And this is also important as you're thinking about who do I want to work with, who do I want to co-found a company with. And the way that we said it is, so for the four of us founded Blavity. I would say that at the time we founded the company, we were close enough so that if any of them invited me to their wedding, I would be excited, but I wouldn't feel obligated to attend. And conversely, if I decided not to show up to that wedding, they wouldn't be mad at me if I didn't come, but they would be excited to have me there. I think like that's the level of friendship that I think is like the perfect level for a founding team. Because if it's more close than that, oftentimes that closeness can then make it hard to trust reporting layers, responsibilities, who's ultimately in charge. But if there's no trust at all, then the team can't function. Right. And so for that, that's what it was for us. And I thought that was a really great sweet spot to be able to build something with people that and that are your friends. But ultimately, at the end of the day, you could still have a professional relationship.
Hi, my name is Joe. I'm with Pop-Up Rhode. And I'm glad that you've found Rhode Island and that it wound up on your radar screen, because I started this Pop-Up Rhode because I love Rhode Island, I really do. And but it's in many ways it's a tough economy. I feel like we're on a tipping point, but we've been saying that forever, right? Like, oh, this is Rhode Island. I'm curious, we're entering an election year, what you guys think Rhode Island needs for us to pop?
So I think Rhode Island's going to be a good spot to be an entrepreneur. So I see a lot of people that are Brooklyn refugees now, right, showing up. And I think the other question is if you can recruit people to your squad from anywhere, like they might Zoom in, I'd rather have them together in the same place so they can Zoom in. But, you know, if you could come here and be 20 minutes from a place you could surf, fish, or sail, that's what I would like to be recruiting to have. So I think Rhode Island's best days are just around the corner, the way you said. I see more and more companies that are not funded by the Slater Fund or by Wright Hill Ventures that are getting $10 million rounds done. So I think that's great, right? It's getting the talent pool is getting deeper and deeper. So if I had to say one thing that would be a little bit different, I would say something like more awesome schools and more trains.
We have another question from the chat.
Yes, and this comes from Toy. Have you made a deal after the first time meeting the founding team? If so, what about them stood out to you the most?
No.
I made a deal. So I had a founder that I said no to meeting to 5 times. He just didn't have, with his material it didn't excite me. I said, he'd send me an email. I'd say, I don't want to meet you. Here's my feedback. And he listened, came back, said, hey, I listened. Here's my updated deck. I'd say no, say blah, blah. 5 times, my partner was like, dude, you can't do that anymore. This poor guy is pouring his heart out to you. You've got to meet with him. And I was like, all right, I'll meet with him. Blew me away. I wouldn't let him leave the room until he shook my hand on a deal. He, and it's been my biggest return to date. It was like an 85x in 18 months. Returned our fund 3 times in the first 18 months. Net. Crushed, like changed my life. Yeah, so I just, because he listened, tried so hard, and took the feedback of coming back and kept on going and going, and perseverance. And then when I met him, he had everything that we've talked about, which I wouldn't have known unless I met him face to face. So I'll take all the credit, but it was really my partner that got me to meet him, and the entrepreneur crushed it. So.
And I would say, you know, the way that my kind of millennial, you know, / Gen Z mindset hears that story is you met him 5 times. And so, you know, I would also say to the question, you know, what it means to meet a VC fund in 2022 is very different than what it means to kind of meet a VC fund in 2014 or, you know, 2010. There's lots of ways to meet an entrepreneur. And that has to do with, you know, that can be a cold email, you know, it can be a Zoom meeting, but it can also be, you know, having a strong presence on Twitter so that, you know, when a VC fund sees you slide in their inbox, they already have a sense of who you are. It can mean kind of having a public presence. It can mean blogging. It can mean, you know, putting your stuff out there in the ecosystem. There's a lot of ways that a person can meet you or meet your company and see what you're doing. And I would say that to play to your strengths as a founder. There might be, you know, if you're really great at podcasting, then like, you know, you create a podcast. The first time an investor may have a face-to-face conversation with you might be the 7th or 8th touch point that they've had with you or your organization. And that can very much strengthen your pitch.
My the Women's Fund just did a deal after the founder or the managing partner of the Women's Fund saw TikTok. I'm not on any social media, but she's like a TikTok freak, saw this awesome TikTok of this awesome woman CEO, and found her in her network, and then 2 weeks later did the deal. I don't think they ever met face to face either, just over Zoom.
So this has been a great event this evening. At this point, I'd like to wind things down. I'd like to thank our 3 panelists this evening: Aaron Samuels, co-founder and COO of Blavity, Thorne Sparkman, Managing Director of the Slater Technology Fund, and Tom Sperry, Co-founder and Managing Director of Rhode Venture Partners. Hopefully you all had a great event, and we thank you all for your time and attention. At this time, I'd like to invite the Executive Director of the Round Business Competition, Beth Carter, up to say a few words.
Thank you so much, all three of you. I think both our online people as well as the ones in the room got a lot out of tonight. So thank you for your time. The reason why I wanted to speak is for a couple of reasons is that we only have 24 more days, people. So for those of you who are looking to apply to the Rhode Island Business Competition, your applications are due at 5 p.m. on the 28th of March. We will not give any extensions for any reasons. Actually, the whole site shuts down. So if you're interested, I strongly suggest you get going on it. The good news this year is if you get to the next round, you will not have to put a business plan together. We have changed it. You only have to put a pitch deck together. So that's a little bit of good news. The other thing too is just to understand what you can potentially win. Not only is there cash, which is always good, but also in-kind services. And those are very valuable. Accounting services from KLR, legal services from Hinckley Allen. There's other types of services like consulting services, co-working space, etc. So I strongly suggest that you think about participating in that. The other thing I want to mention is that we are going to be live for our awards ceremony. We haven't the last 2 years, so I'm very excited about this. It will be May 5th. It will be here. It starts at 5 o'clock. It is open to the public. So if you want to see who we designate as our winner and 2 finalists, I strongly suggest again that you come. We'd love to see you. I'd like to see this room extremely filled, make up for the 2 years that we have been virtual. And in regards to resources, if you go on our website, ri-business.com, we do have a resource tab. We have a lot of information there. If you think of other things, please reach out to us. We're more than willing to expand it. But I also want to mention RiHub. Mia Nolan's here tonight. And they have some great resources available to you too. So there's a lot going on in the state to help entrepreneurs. So we hope you take advantage of all of it. So hopefully we will see you all in May, and I look forward to getting your applications as of March 28th by 5 p.m. Thank you.